No, thank you, Kevin, for the introduction. Thank you, gentlemen, for joining me in this discussion here. So it's January, so I'm feeling still a little bit reflective about 2025. Obviously, Achilleas, the LNG shipping market was not very kind to you. I know GasLog is a little bit insulated because of your long-term charter contracts. But what are your key takeaways from 2025? And are you feeling a little bit more positive with the December rally for 2026?
I was until January came. So I mean, it was an interesting year. The market has been soft. We have been expecting that. We had planned for that. But it was more than what we anticipated. There are many reasons for this. We had many new buildings that have been delivered. This has happened before. It's the classic mismatch between new building deliveries and LNG supplying coming on time, and there are some delays, and also LNG supply comes in stages. The market tries to find a balance. There is some extra vessel availability now. We do have a lot of contracted revenues, but we have seen how soft the market has been in the spot element. Now, 2026, the market tries to find a balance. I think that it will take some more time in the year until we see a better balance. We have more new buildings coming in. But in general, we are quite optimistic about the future. The world will need energy. So I think that it is a matter of time to stabilize.
Okay, and for you, Mads, I think the LPG market was a little bit more varied. The handy-size segment in which you operate, or Navigator Gas operates, was probably less volatile. But key takeaways for you for 2025, and how are you seeing 2026 shape up?
I think, like for most everybody here, 25 was a very volatile year. Q2 was difficult. We had Liberation Day on April 2nd, where we had a trade war starting, and we had some port fees implemented and so on. That kind of hit us in Q2. We saw our customers withdrawing and sitting on their hands for a while. But the good news was that after the end of Q2, things normalized, and we had a really strong Q3. So overall, you could say 25 was a decent year. For Navigator Gas, I mean, we own and operate 57 gas carriers, mainly in the handy-size segment. It is a segment that is more, you could see, stable. The cash flow generation is pretty stable in our segments. We can move between different cargo types. If one cargo type doesn't move, then we can transport others. So. And then 25 ended on a high note for us. Weber Research Advisory ended up ranking 64 listed shipping companies on corporate governance, and we were ranked #1, which was a nice Christmas present for Navigator Gas. But corporate governance is really high on our agenda, and we were very pleased to see that we moved over the past 5 years from 16 to 11 to 7 to 3 to 1st. So that was a good way to end 25.
Oh, that's amazing. Achilleas, as you said, everybody, we need gas. 2028, 2029, if you look ahead, all the projects are expected to finally come online. How do you see between the uncertainties that we have today versus the demand that is coming? Are the charters changing in the discussion? Are they starting to look a little bit more longer term in anticipation of the future capacity that's coming online?
Indeed, you are right. We see this focus in the longer term. Also, there is the expectation that all this madness on the geopolitical environment will at some point normalize and it will disappear. I don't know if it's over-optimistic, but the current environment and the volatility that it was mentioned has not allowed the counterparties to take longer-term decisions. Nobody was ready to take a decision on new projects or new commitments. And it always surprises me when the market is soft that the players and the charters are not coming to fix for longer. I mean, that's the time to fix for longer, and they don't. So we do see today a lot of discussions from the charter side on the longer term, tonnage, securing tonnage for the longer term. And we start seeing a pickup on the new building ordering. It is expected and natural because the LNG fundamentals in the longer term are very strong. Price of the LNG needs to go down because this helps Asia to consume more. Asia is very price sensitive on LNG, and a lot of LNG is going to Europe these days, which is not helping the ton-mile demand. But we definitely see long-term plans on the table and a lot of discussions and optimism on the charter side.
Well, one can only hope that some stability will come, but I think we've got 3 more years before that happens. Mads, for you, what are your charterers, what are your customers concerned about, and is the dynamics changing? I mean, within your space, it's shorter term contracts typically, but what do you...
Yeah, that's right. About 50% of our mix is time charters, and typically those time charters are relatively short, up to 1 year. We have a handful that are longer, but most of them are up to a year. And then we have about 50% of our fleet, which is trading spot. But we kind of like that. When you look at our handysize exposure, which is our, you could say, core business, we operate and own about 35% of the global fleet for handysize. So for anybody, we are the ones who could take that spot exposure and get the most out of it. So that's really what we want to do. And the outlook, I mean, we are pretty confident about the outlook for the next couple of years. 60% of our loadings are taking place in North America. Most of it is out of Texas, exporting natural gas liquids like ethane, propane, butane, and derivative petchems out of the US. And here we see the gas production growth in the Permian Basin in Texas looking really robust. So we expect that the production growth will continue and be, let's say, 15 to 20% growth in total over the next 3 years. And that's just a really good place to be, because that means that the fundamental demand for our transportation services is quite robust.
Okay, so if we can pivot then a little bit from demand into supply, since the prospects seem positive for demand. In the LPG space, obviously the story is a little bit varied based on size. I think for the VLGC market, the order book is about 40% of the fleet, whereas in the handysize we're closer to 10%. Do you think there is enough demand to absorb those ships? And are you worried about any downward pressure from the larger ships, trying to diversify?
Yeah. Our handysize vessels, about half of those are ethane and ethylene capable. So they don't compete with the VLGCs that transport mainly propane and butane. So we're kind of insulated. But we also do have some semi-refrigerated, fully refrigerated handysizes that are, you could say, transporting the same commodities as the VLGCs. I think if we look at this year, production growth is probably going to match pretty well the deliveries that we're going to see in 26. So that's maybe not the biggest concern. And what then happens going into 27, there will also be a lot of VLGCs coming in. Whether production growth will be fully able to offset that or not, we will just have to see. I think for our part, we're pretty insulated from what happens in the VLGC space. But of course, there is a big order book in the VL space, and we are watching that. I think we are pretty confident about the next year or two, but let's see what happens.
Given the age of the fleet, or the aging fleet, are you hopeful that there will finally be some scrapping that will help with the supply coming in? I
mean, if you look at our segment in particular, in the handysize segment, more than 20% of the fleet is more than 20 years of age. So that means that there's a lot of pent-up scrapping. It always tends to disappoint me a little bit how fast those older ships are being scrapped. They tend to stay around for a little bit longer than I'd like. But most of our customers do not accept ships that are more than 25 years of age. So there will be, you could say, a disappearance of those ships into regional trades and so on, where they don't compete with us. So there will be vessels leaving the fleet, and it'll be probably more than deliveries of new vessels coming in. So we could even end up seeing slightly negative fleet growth in the handysize segment over the next 2-3 years. And with the demand background that I just described, that looks pretty good.
Achilleas, 2025 was a record year for scrapping in the LNG space for reasons we've established. Do you see that continuing in 2026?
Probably. We need more. We have older vessels in the LNG fleet mix, especially steams that they are gradually coming out of their legacy charters. I mean, this has been part of our core strategy in GasLog to reduce our residual value risk, and we have been quite successful. We have sold 5 out of the 6 steam vessels that we have. Still, the older vessels in the LNG fleet is a big percentage of the global fleet. So this also explains the extra appetite for new builds, because the improvement of this ratio will come down the road. It is a mix of the technology and the size. The technology is indeed older, and it's more expensive, or they burn more fuel to operate. But it is also the size that hits these vessels, because the unit freight benefit of the increased cargo size of the modern technology is very profitable for the clients, for the charterers. So they have a strong interest to go for a larger size. Now, there are buyers of these assets in Asia that they care less about the technology or the environment, or for trades that they don't reach Europe, that is implementing a very strict tax profile and tax duties and all that stuff. It will depend on how regulations will develop, and we see some deferral of some deadlines on the regulatory environment. Not all countries are supportive, especially US for the moment at least. And this will define how expensive it is to dry dock these assets in order to remain compliant. The critical point of the decision is when you really need to do a dry docking, and you need to pay the extra cost in the capex in order to extend the life and make this profitable. On the other hand, these are older vessels. Usually they have very low, if not at all, debt. So you have only your operating costs, and it's, you just need a decent, relatively balanced charter, and you can really make money. So we have seen this in other sectors, in the older tankers, or in other type of vessels. So that's why we see this hesitation on taking a fast decision to scrap an asset.
Fair enough. Your break-evens, I suppose, would be much lower in these ships, is what we're saying. Speaking then of technology, and this is a question to both of you, do you think that we have the right ships on the water, both from a technology perspective and also sustainable?
I think the existing fleet in the gas tanker market is fit for purpose in a sense. They are not all super energy efficient, and I think if you look at our new building order book, we have 6 vessels on order right now to be delivered in 27 and 28. And what we've been quite careful about is building flexibility into those vessels. So they are dual fuel. That means that they can operate on traditional marine oil, but they can also operate 4 of them on ethane, which is incredibly competitive and a cleaner fuel than traditional marine oil. And then the 2 last ones, they are ammonia for ammonia propulsion. So that means that we have maximum flexibility regardless of where you could say the energy transition and the green transition in shipping, how fast it happens. And I don't think we would ever build a ship that was only relying on, you could say, monofuel, because the world can change fast. We've seen that, and it can change fast again. So we want to be sure that our ships are maximum flexible. We're also investing quite a bit into energy efficiency because it's one of the easiest decisions to make. Often the payback on these additional money paid for energy savings devices, the payback is 1, 3, 5 years. So it tends to be often a very good investment. So I think we need to continue focusing on building energy efficient vessels that are flexible, fit for purpose. But I think in the meantime, our fleet is entirely fit for purpose.
You should also try LNG dual fuel, please. So I would say that the vessels that we take delivery today or that we order today, they are not totally different or they are marginally different from the vessels that we have been building the last 5 years, at least on the LNG side. So they're just more expensive. So, I mean, we really don't see the development on the technology today available in a reliable way that it would come at scale and change the industry. This creates a question mark on what's really the useful life of the asset that you are ordering today, which, as I said, it's already more expensive significantly. I mean, it takes longer to build. It is more expensive, at least at 60+ million of capex compared to our existing vessels, and you don't really have much clarity on for how long you're going to use it. This makes it a riskier investment that it's much more difficult to price it when you take this decision. The fact that there is a lot of liquidity available today that you can use to make the order and take the risk, it doesn't really reduce the risk. So there are much more that you need to think about. So to summarize, we're not convinced that the technology has progressed enough in order to see a rapid, let's say, acceleration of investments. And even if there was, the availability of slots, it would make this technology to come quite late in time.
Yeah, we did discuss the availability of slots. We're looking at 2028, 2029 even, I think, today, if you were to approach a shipyard. But on that basis, then, how quickly are you going to be able to, or ship owners going to be able to respond? All the reports that we are seeing is that there is not enough supply in 2028 and 2029 for the demand that is going to come. So how do you manage that discussions? Will you really just pause in terms of capex, or are you seeing, ship owners starting to take the wallets out in terms of investments?
I mean, from our side, it'll be gradual. We look at both second-hand purchases by consolidating the market. We will continue to make that a focus for our strategy. And when it comes to new buildings, we will do it in a very paced manner. If we are ordering a ship today, it's true that we can only see them in about 3 years' time. When we go to Asia to have a gas tanker vessel built, it's only a handful of yards or so that can and want to build those ships. Maybe 2 in Korea, maybe 3 in China or so. So it's not a very big range of yards that are building gas carriers for our segment. So I think it'll continue to be an issue that it takes a long time to have a vessel built, and that means that we need to plan our capacity needs very carefully. But the second-hand market is probably where we would go and look, and we think there's still lots of scope for consolidation. We think that Navigator Gas has a good platform, and we have, you could say, the capabilities of bringing more vessels onto this platform.
2028 is already gone, so there is no availability for 2028. We did, a quarter ago, an order for 2 new builds that they will be delivered in 2028, and I don't believe that there is any serious availability for that year. At GasLog, at least, we try to take a balanced approach. We try to reduce our exposure in the older tonnage, which we have done, and it's coming gradually the next couple of years. And then at the same time, do some careful ordering, maintaining the balance of the fleet. So we instead of growing, we are maintaining the maturity level by modernizing the fleet and working more on our balance sheet and our capital structure, and we make more. We take less, risk on the volatility that exists today. We have not really seen huge opportunities because there's a lot of pressure and competition from the charterers to extract every last drop of the new building price to take the benefit on the charter rate that they try to fix. There are a lot of tenders around that they are very competitive, so we try to utilize our existing relationships and do more bilateral deals than kill a deal to the last point that to gain the tender process. A lot will depend on the overall environment, the geopolitical tension that it may create conflicts between US and China, the liquidity availability, inflation, the macro environment, interest rates. The shipyards have they have played the game very well. They have increased the prices, increased the pre-delivery financing, the pre-delivery portion of the capex, and they have extended the delivery date. So the mix of all that will define how aggressive people will be on ordering. And new money keep on coming in shipping with funds, private equity, and sources that previously they were not really focusing on shipping. And now we see all this money coming, and this basically increases the competition. But these are not traditional shipping money. So the same way that they came fast one day, they may go the other day.
Yeah, I think it's fair to say there is a lot of liquidity in the market. We are seeing it on our side as well, on the probably less excitedly about how much competition there is. If I were to say that you had unilateral autonomy to make these decisions, where would you put your money? Where would you invest in? Which sector? Would it still be within your respective spaces? What would you do?
Over the past couple of years, we've had a pretty balanced approach in terms of capital deployment. We have implemented a capital return policy where we pay dividends, we do share buybacks, and we are also paying down our debt at more than $100 million a year to the banks. So we'll continue doing that, making sure that we have a robust balance sheet. We have a net debt to EBITDA of around 2.3 times, and we want to protect that strength of the balance sheet so that we can be flexible when opportunities come. Capital return is a big one, but we still have space. We still have the strategic flexibility to go ahead and do selective acquisitions of vessels or even new buildings. And here, we'll probably end up doing both, as we've done in the past. We are selling some of our older ships when they're reaching the past 20 years, and then we go out and source for second hands in the market. They're too expensive right now. We don't like the prices we are seeing, but that's just probably not going to change. And the same goes for the new buildings. We would all love the new building prices to come down, but hey, in all likelihood, it won't. So we would just have to look for those particular opportunities where we can get a good deal, potentially against a time charter with a robust customer. So we will be growing Navigator Gas gradually over the next year as well, adding to our capacity, and at the same time returning capital to shareholders and banks at the same time. So yeah, it's a good place to be.
Probably something similar. It's a good summary, I would say. I mean, we feel quite comfortable with the LNG sector. We have a good strategy, and this has been evident by the very active, shareholding movements that we had. We took the decision to take the company private together with BlackRock, and then now we have the GIC fund coming, which is, this is a positive vote on our strategy and the platform that we have and our ability to employ capital and grow and do things. It validates our business model. So we are quite confident with that. We follow a cautious approach on ordering, and at the same time we pay a lot of debt on an annual basis, which basically reduces the risk that we have, and has a very good match between the contracted revenues and the deleveraging that we do. I believe that I see more of the same, like the bread and butter of ordering new builds and increasing the EBITDA that increase the valuation, and you create value in the longer term rather than something very aggressive and opportunistic. M&A activity, I find it difficult. I fail to see the synergies. I mean, we already have a platform. We don't need a second. And the prices that we see out there are quite expensive. So why should I pay the new building equivalent price for a 2, 3, or 5 years vessel? I just go and build a new one if the price is the same. And this is what we see. So if we see any type of M&A activity, probably it will come again from the private money or the funds or the big players or governments that they want to make a move.
So I've been given the nod on time, but thank you both very much for joining me today in this discussion, and thanks everyone for listening.
Thank you, Audrey.